All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Hope you had a fantastic weekend. Markets off and cooking here Monday morning, and Bank of America was our only challenge position on the board. Option trading right now at 91 cents, so we're down about 450 on the option. And this afternoon we'll be hitting the auto exit date for any red trades. So we need Bank of America to mount a 25-35 cent charge here into the close to be able to hold on to Bank of America. And which personally I would love to do, but it does need to make that little bit of charge there on it. But we're sitting here with the 12.5 in gains, which has kind of been the challenge ceiling here over the last two and a half weeks. We keep bumping up on this number, and not able to really eclipse that aggressively here, but still in a good position, plenty of cash to go and take advantage of the next signals. There are no trade signals on the board right now. There are some potential here this afternoon. Things like a Microsoft here, and I'll go through and show the scan of all the 3.7s. But Microsoft is one that showed up that if this were the afternoon, it would probably be a trigger. But it's not a trigger here this morning just yet. Microsoft had earnings last week, Thursday after the bell. We saw the stock gap up over 140, pretty much sell off all day Friday, and bouncing back up here, back up here today. We talked about Microsoft earnings; they were fantastic earnings, right? Yeah, and let's just make this very clear: the reaction to earnings does not dictate what the earnings were. Right, we see that over and over in the market. The reaction to earnings does not dictate what the earnings were, and a lot of times you'll see a very sour reaction, and then the stock just get bought up after that. Or you see a really good reaction or bullish reaction, stock just gets sold off after that. And the buying and selling that happens post earnings is not always indicative of what those earnings were. And for a number of reasons, and we've talked about many of those in the past. Okay, so challenge still in cash, no new signals here this morning, still holding Bank of America, and running here with it. Bank of America up, 7 cents here this morning. It did gap down a little bit this morning like the rest of the banks, but Bank of America trading right along with the majority of the banks out there. The news cycle is the same out there. The Iranian saber rattling continuing. They are upping the ante. They are definitely upping the ante there with some of the stuff going on. And that's, as we mentioned a couple months ago, it's not a new story, and it's not going to be one of those stories that goes away anytime soon. The Iranian saber rattling is something that is going to be with these markets for the foreseeable future. And we could be talking years before anything really changes dynamically there with the situation. And we'll have flare-ups and little events and all of that. And some events that'll be pretty tragic, and some events that'll be kind of, whatever. But, from a market standpoint, is it going to garner a huge reaction? It will when missiles fly, if that is the case, and hopefully it's not. But we'll see a reaction there, and, it's one where you could make an argument that, Iranian war is actually bullish for stocks, right? It's not a very comfortable argument to make, as it does kind of lead to some sad commentaries on where we are as a civilization. But you can make that argument. You could also make the argument we drop stocks initially and then rally them there. But regardless, it's going to be one of those situations that isn't very predictable about timing, right? But is one where it's going to be with the markets for a long period of time. We had U.S. President Trump this weekend coming out and criticizing the Fed again, right? And we talked last week why he would be so opposed to what the Fed is doing and really want the Fed to drop rates. We talked about that global comparison. We looked at Greek bonds, right, where Greek bonds were relative to U.S. bonds. And when short-term Greek bonds are trading cheaper than short-term U.S. bonds, bonds, and you compare the two economies, something is pretty out of whack, right? And that's kind of where President Trump is kind of going and saying, look, come on, I know you guys want to get back to normalization, but there's a new normal, and if you look around the world, we're losing some of our competitive landscape, or the U.S. is losing some of their competitive landscape because of what the Fed is doing. And, whether you agree with the argument or not, that's the argument that's being made, and, will continue to be made. Will absolutely continue to be made. When we saw the market sell off Friday afternoon, right, the market was dealing with two things. It was dealing, and here we go. Here's the sell-off, but the market was dealing with two things. It was dealing with the Fed's Rosengren basically coming out and saying, no rate cuts are needed, and then you had the whole Iranian British ship detention going on there. So both those things just kind of serve to create some some selling pressure into the close there on Friday. We saw some stocks, reverse sharply. Others just kind of, ignore it. But, definitely definitely was a short-term driver here for it. And, a sell-off magnitude that was a little different than what we have seen of late, and a sell-off volume that is a little bit different than what we've seen of late. And it's the kind of sell-off that makes me look at a gap up this morning and go, okay, a gap up this morning may be buyable, but it needs a catalyst. Is there a catalyst out there driving this market higher this morning? And the answer is absolutely not. There's not. There's not a singular catalyst you can point to and say, that's driving the market higher this morning. There are some, upgrade, downgrade types of things. We saw some earnings out of Halliburton and everything else, but, this is just kind of a little snapback into, some of that selling area here this morning. Now, what I find the most interesting about the news cycle this morning, it comes down to the S&P. It comes down to Micron. And it deals with Goldman Sachs. Goldman Sachs this morning came out and upgraded Micron to conviction buy. They've had a hold rating on Micron, and they basically cited the last earnings report, some of the shift in the flash memory market as a buy reason for Micron. And we're back into that. Everybody wants to buy Micron mode. The volumes are fantastic. Path of least resistance is absolutely higher. We talked about it on earnings that just changed the dynamic change there. And you go, okay, Goldman Sachs comes out, puts Micron to conviction buy. But Goldman Sachs also came out on the market and basically said the market doesn't have far to rally the rest of the year. It's already up, 18% on the year. To see it put in massive gains the rest of the year is very slim chance. So you have a company come out and basically kind of have a commentary basically saying market's not going to go anywhere for, the rest of the year. And then upgrading something like Micron to conviction buy. And what's that tell us? That tells us exactly what we have known. That this market right now is not about where does the market go. It's not about, is the market going to drop? Is the market going to pop? Is it? Yes, it's going to do both. It's going to have some dip. It's going to have some rip. And when the market hits some of those extremes, we're going to see, a counter move, to them. Just like we saw back here in May where the market dipped down, we saw kind of a little oversold area, and we saw that get bought up and rip, right? Right now it's been in this kind of consolidation phase. But right now this market's not about where does the market go. It's much more about where do individual stocks and sectors go, and there's a high level of differentiation as the bond market's basically been crushed. And there's rotation between, tech and banks and real estate and utilities versus industrials and materials, right? That is going to continue, right? And we're going to see some sectors fly high. Even when the market drops, we're going to see some sectors really lag even when the market pops. And so this will continue to be much more of a sectoral market going forward. And I think that's the takeaway from, what we've seen this morning here out of Goldman Sachs. And, some people say, hey, Goldman Sachs rules the world, in terms of they control everything. Not so much anymore, right? We can point to a lot of different things where Goldman's been dead wrong, but there are a lot of times where they've been absolutely dead right, and they upgraded FedEx here 2 weeks ago. FedEx has rallied about $10 since. It's so interesting to see them coming out upgrading certain stocks, but yet still having that view on the market, and it's not too surprising. It's a theme that we've been talking about here for a while. Now, I want to go take a look individually at a company here, Halliburton, and this is on the challenge watch list, so I want to break it down here just a little bit. There are two factors I want to break down. I want to break down the fundamentals here after the earnings report this morning, and I want to break down a possible trade that didn't happen, that was pointed out to me in real time when it happened, and I said, okay, we'll follow it and see what it shapes up to be. Let's start with the trade side, right? Halliburton had this element of rallied, and then it had the downside 3-7 cross on this day right here last week, Tuesday of last week. And it didn't trigger bearish for the challenge. And one of you, mentioned it to me and said, hey, and this was one that I thought would trigger bearish as well, but ultimately it didn't. And, came in, hey, why wouldn't this trigger bearish? It has everything it needs. Lower highs, 3-7 downside crossover, the Stoke 39.1, showed me all the stuff that, I visually show. And I said, look, it's not qualifying because of the way this price action is relative to past history. And, it was one where, I was kind of disappointed. I wanted to trade it lower and everything else. But the bottom line is that the chance of continued trend was low, and that's what the algorithm showed, is that it was relatively low. The next day, the stock snapped on down, right? Snapped on down, had a bad day. The last 2 days just kind of crawling around, then today jump up. Well, the put options from where they were Tuesday afternoon to where they are right now, the put options are down 60%. Right, had we bought puts on that where it wasn't a signal, we'd be down 60% on it right here, right now. Now, granted, probably let's see where the average true range is. The average true range is 75 cents. So, nope, we would not have been able to get out with any sort of profit taking. Here on the downside, this would have been, hey, hold. We don't have our 2 average true range moves, so we'd be in a full position here, right here today, and down 60%. Right. The algorithm doesn't just take into account what is this stock going to do tomorrow. In fact, it doesn't care what the stock does tomorrow. It doesn't take that into account in any way, shape, or form. And I understand a lot of traders, that's what they want. What's the stock going to do tomorrow? What's it going to do in the next 10 minutes? What's going to do in the next 30 minutes? But the algorithm doesn't take that into account at all. It takes into account the probability of a trend. And, it doesn't say anything about where's the stock going tomorrow and all of that. And, everything we look at when a signal happens or when we exit a signal, you hear me talk about it in terms of probability of trend, right? And that is just something that will continue, and it's something that, in many cases will keep us protected, out of trades like a Halliburton. And in some cases can maybe be a little bit maddening because we're in and off it goes, and yet the trend continues. But after this kind of 4-day wobble, right, we end up getting knocked out, and the stock continues our way. It's going to happen in both directions. What happens after the trade exit or after no signal or anything like that, it's not significant. We're going to be able to find examples where everything happens, right? We'll see stuff that goes dramatically our way had we held it, dramatically against us had we held it, right? We're going to be able to see all sides of the coin. The reality is it's playing the probabilities. And for as much as I hated to exit Nike on Friday and I wanted the exposure, Target, and I wanted the exposure and everything, it was just, hey, you know what? Probabilities at this point just aren't in my favor, and I got to go. No matter how much I like the chart, right? It's about the automation of the odds and, the back history and playing, the odds in our favor. It will continue to be. Okay? So let's go back to Halliburton. Halliburton up big here today on earnings. And I'm not advocating going out and buying it right here, right now, but do want to show you a couple things. You've heard me say a lot in the past, when you have a stock where the PE ratio and the forward PE ratio are both lower than the earnings per share growth this year and next year, you have a stock, the path of least resistance is higher. The chance of this stock going higher is very high, and the chance of it moving sharply and sustainably for a longer period of time is also very high. If you look at Halliburton, it's in that position. It's absolutely in that position where the PE, forward PE are significantly lower than the earnings per share growth rates for both this year and next year. Okay? Which puts it in a fairly bullish position. Now, 3% short float, right? Great. Now, Halliburton's up on the earnings today, but I mentioned on Friday, Schlumberger reported earnings, right? Schlumberger reported earnings, and they weren't great earnings. I'd kind of put them in the Halliburton camp. Not great earnings, but Schlumberger did not fall on their earnings. And there were many reasons that you could have pointed to with Schlumberger to say, hey, this thing should have fallen on earnings. And it failed to fall on its earnings, right? We failed to see Halliburton sell off. We failed to see some of that. Now, is there an Iranian situation in there kind of keeping a little bit of buy pressure in these? Yeah, probably, right? But if we come in and we now start to break these down fundamentally and start to look at them and say, you know what, are these things at that point where, you know what, everybody's just so sour on them that the path of least resistance has to be higher? Right? And you're not going to hear a lot of people create a real bullish thesis or real bullish story for them and things like that. But you never do at the bottoms. You never do when a stock is turning, right? Well, let's take a look at Halliburton in terms of metrics, right? We'll take a look at some of the valuation metrics, like a PE ratio, right? So we'll come into a PE ratio, and here we'll compare it to the last 10 years. PE ratio is at 11, right? We saw that. Does it mean anything? No, not really. Who cares, right? It just in this context of being able to compare it to itself, right? Well, let's go to price to sales, right? Which for a company like Halliburton is oftentimes a little more significant. And the price to sales ratio, right? Price of the stock relative to the sales is at a 10-year low. That means this isn't just necessarily dropping because sales are dropping. The price of the stock relative to its sales is really low. In fact, historically low here for Halliburton. If we come into a max chart, we can see that, yes, there were times where it got this low. But the last time was during the financial crisis. Before that was, during kind of the end of the, 2001, 2002 big bad bear market, right? So, this is one of the lowest price to sales numbers that we have seen here on Halliburton on a historical basis, right? So, we can start bringing in that historically cheap type of argument, right? Price to book value. Well, let's take a look at it, right? Let's just go back 10 years. But here's the price to book. It's trading at 2 times book. The last time it was trading at 2 times book was back here in February and January of 2016. And if you go back and you look in the Trader Minute archives and you look for some of the oil videos at that time, we did a big video on why oil has bottomed and why the fundamentals on oil stocks are to be bought because of their historical cheapness. And it was a hard time to be a buyer, right? The news cycle was very negative. But what did we see? We saw it really turn around in a big way. Halliburton, it went up pretty darn big, over the next 2 years. But it has finally had a pullback, bringing it back down into this level, on a price to book standpoint, to where it is not just cheap, but historically cheap, right? Historically cheap. And we see that with the price to sales. We see that with the price to book. And, PE ratio is very low, right? But, PE ratio, because earnings on Halliburton go negative, just doesn't give us a good look over time. So we're talking about a stock that is just very cheap, right, in terms of Halliburton. It's very cheap. But take a look at its cheapness relative to its revenue. A lot of times stocks get really cheap because their revenue has fallen off and because their revenue is near lows. But look at the revenue. The revenue for Halliburton is almost 50% higher than what the revenue was on the troughs here in 2010 and 2017. It's almost 50% higher in terms of revenue, $16 billion to $24 billion. Right? So we have a company that's trading on some of these historically cheap levels, whose revenue is nowhere near these historical lows. That's typically a decent sign that there's there's something else that's been going on to drive that stock lower, and it's, kind of in that, in the sin bin there, to use a hockey term, and not something that is, necessarily being sold on its merits, but sold basically because, well, it's just not investable where it sits. I would never buy Halliburton because of a dividend, right? But dividend yield can be looked at to say, hey, is this stock cheap or expensive historically, right? And right now, the dividend yield on Halliburton is over 3%, and that is absolutely unheard of. Look, over the last 10 years, we've never seen a dividend yield over 3%. Is that because Halliburton's raising their dividend? No, it's because, look, the stock just continues to sell off, and so the relative value in terms of the dividend continues to increase there. If we come to a max time period, we saw Halliburton's dividend up at these levels back here in 2002 at the end of the big bad bear market, but a lot's changed since then, right? The world very different since 2010, 2011, when we saw all the quantitative easing come in, and we were talking about Halliburton trading at a dividend level that is basically an all-time high in the new market. So, whatever valuation metric we want to look at, we can find that Halliburton is really cheap. They're really cheap when their revenues are 50% higher than what they have been on some of their recent troughs. Are we talking about a stock that's just been left for dead? Are we talking about a stock that's been forgotten, that has become kind of uninvestable? Yeah, we absolutely are, right? But oftentimes these can be some of the best opportunities in the market, some of the absolute best long-term opportunities. And when we look at the Schlumberger earnings and we look at the Halliburton earnings this quarter, right? These are two stocks. They're not immune to going down further, right? They're just not immune to going down further, and they're not stuff I'm advocating buying right here today. But they are two stocks I'm advocating putting on your watch list and looking for an opportunity to be a buyer on the next sell-off. On the next sell-off. And, it is something where if you look at some of the longer-term charts, like a weekly chart here for Halliburton, right, there's not a lot to love here just yet. But when there is, when we start to see money come in, it's not just going to be a 10% bounce. It's not just going to be a 15% bounce. This is the type of thing that we are going to see a move like 2016 come into play again for Halliburton. And it's probably not going to get back to these 2017, 2018 levels. We'll probably just be talking about it getting back into the upper 30s. But on a $24, $22 stock, getting to the upper 30s is an absolute monster move, and is something to take a look at. And where you go, okay, what's it going to take? I mean, if this thing sells off to 20, how cheap are those fundamentals? They're even cheaper, and something really has to be big time wrong. So, it is something where, we'll trade it with the challenge when challenge signals come in. But when it comes to just the investment side of Halliburton, take a closer look. This is one that has been left for dead by many in the market, and it's one that you've heard me talk about for a while. Just not too keen on. We talked about some of the bullish prospects here in 2019 with what the CEO was saying, but we also talked about how the CEO had a bias, right? A big bias there. When we looked at the fundamentals, they were nowhere near as cheap as where the fundamentals are today. And today, they're absolutely historically cheap. Thanks for hopping on. Have yourselves a fantastic day. I'll be back on with you here this afternoon, and we'll talk to you then. Take care.